Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis welcoming you to Money Talk for Wednesday the 21st of August. Thank you for listening and for making this show one of the most listened to business and finance podcasts in Hong Kong. That's according to Pod Status. And this podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's business and finance headlines, China left key interest rates unchanged on Tuesday as expected. The one-year loan prime rate, the benchmark for most corporate and household loans, was maintained at 3.45%. Meanwhile, the 5-year LPR, a reference for property mortgages, was retained at 3.85%. Both rates stay at record lows, following unexpected rate reductions in July. Chinese property developer Kaiser announced Tuesday a restructuring plan that aims to provide a route to stabilising its business. The company was the biggest borrower of offshore debt behind Evergrande, and under the terms of the agreement, the property developer plans to issue new dollar notes totaling more than $5 billion in several tranches. Additionally, the company intends to compensate creditors with convertible bonds with an aggregate principal worth $4.8 billion, which can be swapped for new shares. Brussels plans to hit Tesla cars imported into the EU from China with tariffs of 9%, but that is a rate that is lower than those for Chinese electric vehicle makers. The European Union on Tuesday said planned tariffs on Tesla vehicles being imported from China will be cut to 9% from 20.8%, while also reducing a number of planned import duties on other Chinese electric vehicle firms. Hong Kong's inflation rate has jumped to an 8-month high. The annual inflation rate in Hong Kong climbed to 2.5% in July from 1.5% in the previous month, easily surpassing economists' forecasts of 1.6%. And on a monthly basis, consumer prices rose 1% in July. That's the most since October 2023 and is up from 0.5% in the previous month. On today's programme, I'm joined by Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and Carlos Casanova, Senior Asia Economist at UBP. And with a view from Japan is Tokyo-based journalist and author William Pesek. If you want to get in touch with any questions or comments, please go to my website, peterlewismoneytalk.substack.com. That's where you'll also find today's edition of my Asian business newsletter. On Wall Street Tuesday, US stocks put an end to their longest win streak of 2024 as investors await insight from Federal Reserve officials at their annual Jackson Hole Symposium. The S&P 500 slid 0.2% to 5,597. The Dow lost 62 points, or 0.2%, to end at 40,835. And the Nasdaq Composite shed 0.33% to 17,817. Tuesday's declines snapped 8-day winning streaks for the S&P 500 and Nasdaq. That's the longest winning runs since the end of 2023. The Dow notched its first negative day in the last 6. The yield on the 2-year Treasury note dropped below 4% ahead of the release of FOMC minutes later today. The 2-year yield fell 8 basis points to 3.99%. The 10-year was down 5 basis points at 3.81%. And the US dollar hit its lowest level since the start of the year on Tuesday as investors braced for the Federal Reserve to start lowering interest rates. The US dollar index dropped 0.5% to 101.41, a level not seen since the first trading day of January. The yen rose 0.9% to 145.37, and the Japanese currency is up over 7% against the greenback over the past month. Chinese yuan climbed 0.1% in Shanghai to 7.1320 renminbi per dollar. The onshore yuan is up 1.2% this month, despite a slowdown in demand from China. Gold rose 0.5% to $2,516 per ounce on Tuesday. That's a new record high. And Brent crude oil settled 0.6% lower at $77.20 a barrel. Bitcoin jumped up above $61,000 during the Asian trading session yesterday, then was sold off during the US session. It ended the day almost unchanged, around $59,500. Chinese shares lagged behind the rest of Asia Tuesday. Hong Kong's Hang Seng was down 58 points, a third of a percent at 17,511. Mainland China's Shanghai Composite fell 0.9%, snapping a three-day winning streak. And the Hang Seng projected to open about 210 points lower this morning at around 17,300. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Halfway through the week, let's welcome our guests. We have with us our regular Wednesday morning commentator, Enzio von Pfeil, who's capital preservation specialist at Financial Shield. Good morning, Enzio.
Good morning, Peter.
And also joining us is Carlos Casanova, senior Asia Economist at Union Bancaire Privé in Hong Kong. Morning, Carlos.
Good morning, Peter.
China left key interest rates unchanged on Tuesday, as expected. The one-year LPR is at 3.45%. The five-year LPR, which is the reference for property mortgages, was retained at 3.85%. Both rates are at record lows following an unexpected rate reduction in July. NGO, the PBOC, has been talking about taking more steps, although not doing any drastic ones. Is there room to cut these rates further?
Sure, there's room, but I don't think it's going to be effective at all, and for a very basic logical reason that the People's Bank is trying to solve a structural problem with cyclical tools, and that's just a bit like giving an alcoholic some aspirin and saying that I hope you get rid of your hangover. So my view is that these short-term measures, even fiscal stimuli, they're all based really on cyclical stuff, and that doesn't work. The fact is that was put very well by Zhou Xin in yesterday's South China Morning Post here in his My Take column that it's the current government's constant, quote-unquote, constant hostility towards the private capital. So instead of promulgating that public ownership is more, instead promulgating that public ownership is more politically correct. And now the private sector accounts for about 80% of all employment. And if you thwart that private sector, then why should private entrepreneurs want to employ people? And then the whole thing just goes to hell in a handbasket, basically. And that's why I think that China is in a structural L. I'm not going cockney yet. It is a letter L. And I'm afraid that's going to stay. It's going to become what Japan was for 30 years, very deflationary. Japan is finally getting out of it. We'll get into that later. But China is stuck in L because of this hostility towards the private capital, according to Zhou Jin.
Is there anything the PBOC can be doing? I mean, the Pan Gongsheng, the head of the PBOC, says he wants to avoid taking any drastic measures for the economy. Well, I'm wondering what he means by that and what, in effect, the PBOC can do.
Well, they're a little bit stuck, I think, because if they cut rates too much, then, of course, the renminbi is going to sag, and that then gives rise to imported inflation. But enough of me. I think it's really time for Carlos to also give us a bit of his pearls of wisdom.
Yep, Carlos, what do you think about this? I mean, a lot of people were calling for the PBOC to enact more stimulus, particularly after we saw the activity data for July was pretty gloomy, wasn't it?
Well, it was very unlikely for them to do anything this week, as we are coming off rate cuts last month. So they did an outsized 20 basis points to the medium-term lending facility and 10 basis points to the loan prime rate. So, of course, it's too soon to cut rates again. So that wasn't going to happen this week. But between the rate cuts and this meeting, we've seen very disappointing July data that suggests that the economy is not on track to meet that 4% growth target, 5% growth target, but also, under a lot of pressure in the third quarter. So PBOC needs to do more. I think the issue is, as Enzio rightly pointed out, that the problem is structural, and so there is only so much that cyclical measures, can do. So there's a whole conversation about transmission of rate cuts and issues in policy transmission. They are moving towards a different mechanism where they target short-term rates. So they've now abandoned the medium-term lending facility and the loan prime rate as a key tool, and they're looking at the 7-day reverse repo because they think that the emphasis should be on liquidity, ensuring liquidity is flowing to the right sectors, and so on and so forth. And so we are in a bit of a transition stage at the moment, and it's difficult to predict how that's going to pan out for monetary policy in 2025. So that's one thing. I do think there's room for them to cut rates in the fourth quarter. Again, it won't be substantial. It will be another 10 basis points, give or take. That is not going to move the needle, but it's going to be part of a series of measures that try to put a floor, at least, on some of the structural pressures that the economy is facing.
And what is the impact of this change in focus on the rates from the loan prime rates to the reverse repo rate? What in a practice does that mean?
Well, in practice, the LPR and medium-term lending facility rates have little bearing over the Shanghai Interbank offered rate or borrowing costs in China. Those have been going down gradually over the past 2 years, and so are much more closely correlated and in line with the 7-day reverse repo rate. So what was happening is there was a complete disconnect. And so what they're trying to do is they're trying to narrow the interest rate corridor further to have a lot more control over the direction of interest rates. I think it entails that once you have some recovery in real estate investment in tier 1 cities, and this monetary policy changes have been implemented, it means that the central bank will have a lot more control over cutting rates and those actually translating into better demand. But you need both to happen simultaneously. So you need the fiscal to take place in tandem with the monetary. You need housing prices to stabilize, at least in tier 1 cities. And so, everyone's focusing on the PBOC. But to be honest, I am looking at that 3% fiscal deficit target and thinking, hell, when are they going to increase this to at least 4% of GDP? When are they going to announce more bond issuance? When are they going to move some of the quota from next year into this year? Because the situation in the third quarter is pretty dire. So for me, this market's been obsessed with the PBOC, obsessed with the 10-year yield moving below 2.1%. And for me, it's like, where is the fiscal? Where's the money? That's what I'm focusing on.
And the economy needs it, doesn't it? Because that housing data was pretty disappointing, wasn't it? We were hoping that maybe there'll be signs of a bottoming of the housing market, but it doesn't seem to be happening.
Again, I just come back to a very simplistic point that if people are what I call income insecure, and we all know this, then they're just going to tighten their belts, as we're also seeing in Hong Kong. And so I just don't see any way out. They can... it's band-aids with the monetary side, but I can't see that causing a liftoff. And again, because of this government hostility, as pointed out by Zhou Xin, to the private sector, and I think that's the real bugaboo.
Carlos, what are you seeing there? It didn't look very encouraging, did it? The housing market, new home prices still falling, sales still falling. There doesn't seem to be any sign of a plateauing out of the housing markets.
Anecdotally, we hear that there are pockets of opportunity within first-tier cities. So some of the developers have been allegedly selling luxury units very quickly because, of course, everybody can now buy a house in a first-tier city. So you have wealthy individuals from second and third-tier cities that are looking to diversify their eggs that may have previously been too concentrated in one area. I was hoping that we would see an extension of what we saw in June with some signs of a divergence in tier 1 and tier 2 cities. Unfortunately, it didn't happen. So we've read the news, but that's not yet translated into a pickup in real estate prices in tier 1 cities. In fact, the tier 1 city home prices contracted the most since, the beginning of the year or something. So the pace of contraction exceeded expectations, and that was a little bit disappointing in my opinion. The silver lining seems to be that real estate investment is slowly starting to inflect. We are still very negative, but the line doesn't keep going down. But I wonder to what extent that is reflecting also base effects from last year. Remember, this contraction is now in its second year, versus them getting on with the construction of those sold units that never got finished, or the government actually doing more to sort of invest in these in developments to turn them into social housing. I suspect that the base effect is probably a bigger driver of that inflection. So that's why I continue to monitor prices. I think home prices in tier one cities, that's going to be the canary in the coal mine until we see bifurcation. I'm afraid that what Enzio was discussing with income insecurity and the sentiment being very negative will prevail.
One thing, Peter, if I may just add, we haven't yet discussed the importance of pigs to economic rejuvenation. Of course, I'm being sarcastic because the July inflation rate rose by an eye-popping 0.5% year on year. The consumer prices, I believe, please correct me. But apparently a lot of that was a 20% jump in pig prices. So many people thought, oh, this is the sign that demand is picking up and inflation's coming back. I don't know how pigs are going to haul China out of this trough of deflation, but we'll have to see.
Mm-hmm. So given that there really is still no inflation in China, why is the PBOC so wound up about the bond market? It sort of almost wants to do a sort of a reverse QE, doesn't it, and stop bond yields from going down. And it's talking about people recklessly buying bonds. It seems quite reasonable, doesn't it, that bond yields are going down and hitting record lows at the moment?
Yeah, it reflects a lack of investment opportunity. So typically 70% of household wealth is linked to real estate. The underlying value of these assets keeps going down. So people are looking for something that is a safe haven asset, and gold was one of those assets earlier in the year. They've clamped down on that, and so now people are moving on to the government bond. The problem seems to be that it could be deflationary. So if the bond goes down too much, or if the yield curve inflects, it could be a sign that the economy is going to enter a recession, and it could entail that deflationary expectations become entrenched. So for me, it's not that complicated, actually. They want to continue to manage interest rates down, especially at the front end of the curve, while anchoring the long end of the curve, or the 10-year yield, at around 2.1 would be the floor. I would say around 2.3 is the level that they're comfortable with, so that you have a decline or a shift down in the yield curve, but the slope of the curve continues to be positive, so as to prevent deflationary expectations from becoming entrenched. As Enzio mentioned, food prices were the main driver of that uptick last month. I think pork prices were up, of course, a big component of the CPI basket, but remember that China experienced adverse weather, and so vegetable prices soared by even more than that. So it's really reflecting one-off effects on food rather than broad-based recovery in consumption. So that's why the PBOC needs to maintain that slope positive, the steepness of the curve positively sloped, or else they could be in a much more difficult structural paradigm.
The trouble is, the banks
Peter,
don't.
If I could just add, sorry.
The trouble is, the banks don't want to play along with that, really, do they? Particularly the rural lenders, because there's not much demand for loans at the moment, so they haven't got much else they can do other than park it in treasury bonds.
I think that's. I mean, adding to Carlos is what he's saying. I think another facet is exactly what you were saying, which is the PBOC's fear of a bond bubble. In other words, that just too much going into bonds helter-skelter, and then pop goes the weasel. Mm-hmm. So I think that's also a concern of the central bank that was certainly aired in The Economist. Not that I really followed it a great deal, what the actual argument was, but just too much bond buying. And if one of these bonds goes a bit cuckoo, well, then the whole thing sort of comes tumbling down. So that's, I think, that's another concern on top of Carlos's very good points.
Yes, that's correct.
Well, the other place, of course, where there's a focus on interest rates this week, apart from China, is the US. Central bankers are gathering at Jackson Hole once again for their annual symposium. I get the feeling there's a lot of potential here for markets to move a lot on Friday when Jerome Powell gives his speech, because clearly they're expecting fairly strong signals that the Fed is going to cut rates in September. If it doesn't get it, do you think we could see another sell-off in the markets?
Absolutely. I think that, but I'm not a great believer in these bond market, in these Mr. Market's predictions. It's perhaps I'm being a bit of a smart aleck, but last year they actually they forecast, I believe, 6 rate cuts, and then kind of left that room with their tail between their legs. So I think it's very short term what they're thinking, and so the whole thing is totally mucked up now by algorithms and all this kind of stuff. So I think that clouds the interest rate outlook a hell of a lot, actually.
Jackson Hole is very important. It's like the World Economic Forum or the Davos of central banks. So this is definitely a question that has come up a lot this week. Remember that during COVID, it was after this meeting that all of the central banks in the world agreed to cut rates in tandem. So we could see something similar happening after the meeting this week. Market is, as usual, getting ahead of itself, and so is pricing in 75 this year, which entails either 3 consecutive rate cuts or an outsized 50 basis point rate cut in September. And I think that's what we are looking for in Davos, in Jackson Hole.
Jackson Hole, yeah.
Yes. So there's the expectation that they will give forward guidance as to the size of the rate cut in September. Remember that based on the Fed inflation scenario, headline inflation should gradually converge towards the implicit 2.5% target range by year end. So a 25 basis point cut in December based on the inflation scenario is possible. September is more preemptive because the other side of the congressional mandate of the Fed is employment, and there are signs of weakness, especially in services. And so they could do something in September in order to prevent risks from materializing. Unfortunately, I think the data has been quite mixed, and so I would brace for a disappointment. I don't think that they will suggest 50 basis points in September, but I think they will go ahead with a 25 basis point rate cut, as there is a lot of pressure at the moment and signs that labor market is weakening.
So not to be forgotten that. Yep. Sorry, Peter. Yeah.
Carry on, Enzio.
Oh yeah. No. Just again, adding to what Carlos was saying, that this personal consumption expenditure index, which is really what they look at, that was up 2.6% year on year. And now we're not going to digit bash, but that's still 30% above the Fed's target of 2% for that inflation variable. So I agree with Carlos. I think the Fed wants to be seen to be measured, particularly in an election year where I don't think they want to be seen to be trying to help the one party or the other. So, of course, Donald Trump doesn't think we should have an interest rate cut. God help us if he becomes the central bank governor on top of everything else. So I just want to add that in, that the per capita expenditure price index is still at 2.6%, is still running at some 30% above its target rate.
And what does it mean for people out here? If we get this interest rate cut, what does it mean for people's own sort of financial circumstances?
In Hong Kong, or
in Hong Kong,
where you think? Okay, well, I mean, obviously all the consumer lending prices go down. Carlos can maybe tell us a little bit more about the mortgage market here. I don't know whether the short-term rates, like the Fed funds, obviously have much of an impact on Hong Kong's mortgage rates. I don't know that. But certainly on the consumer lending side, we've got a pegged dollar, so there's not a lot going to happen on that side.
Carlos?
Yeah, on the mortgage front, I think the P rate is currently lower than the policy rate. Yeah. So a 25 basis point cut in September, I don't think would move the needle significantly for Hong Kong. I know everybody is bracing for a rebound in housing prices after the Fed starts to cut rates in September. I'm more cautious. I think that may not happen. Moreover, is if, as we've been discussing, it's disappointing, then we could see a bit of a sell-off in equities, or at least some sector rotation. So investors in the region are exposed typically to US equities, and so they should be preparing for a little bit of volatility depending on what happens on Friday.
And tell me about out here, other central banks. We've seen a couple of cuts now, haven't we? In New Zealand, we've seen an interest rate cut. In the Philippines, we've seen an interest rate cut. Is this the start now of a rate cutting cycle in Asia? We've got the Bank of Korea meeting this week, also Bank Indonesia meeting as well. What do you think, Carlos?
Yeah, I actually sent a report saying, central bank decoupling. So potentially a little bit exaggerated, given that the September rate cut is pretty much priced in. So these central banks are acting with some visibility that the Fed's going to cut interest rates. But they're certainly not waiting for the Fed. We've already seen the Reserve Bank of New Zealand and the BSP, the Filipino Central Bank, delivering rate cuts. And most central banks are going to embark in an easing cycle over the coming months. This week, we do think that Bank of Korea might have to wait a little bit because of one-off uptick in CPI prices. So they really don't have all of the data, although they could argue that it's a one-off and they know that direction of travel is clear and they could do a preemptive rate cut, but that is not what the consensus is telling us. I think almost all of the economists surveyed expect the bank to hold this week, but to deliver a rate cut in the fourth quarter. And so we are seeing some decoupling of sorts with Asian central banks getting on with their easing cycles because inflation is not as big an issue here. Of course, we have a big economy, China, that is deflationary, so that helps. But also the employment situation isn't as rosy as in the US. So a lot of these economies, excluding potentially Australia and maybe Japan, have seen unemployment rates return to above pre-COVID levels. And so that is one factor that's helping with deflation. So they are ready to deliver policy support, and we are seeing that happening as we speak.
And Enzio, what about Japan, the other big economy out here? We've seen GDP expand now better than expected, an annual pace of 3.1%. This is presumably what the Bank of Japan wants to see.
Yes, and particularly the poor employees, the salaryman, as we know them from Japan. You put out in your note this morning that the personal spending may finally be underway after large companies agreed to offer the biggest wage increases in more than 3 decades, and the government implemented a tax rebate. I think that's very important because if the Japanese consumer starts getting a little bit more income secure again, then I think it's not going to take off, and because that's not what Japan is about these days. But I think at least it will get out of its deflationary rut. And that's actually, I think that's probably the best news on Asia. I just want to add to Carlos's point that, of course, if the central banks don't all cut here, in other words, if one stays stuck it out with like a sore thumb, then that exchange rate might rise relative to the other Asians, and that might hit some of the export competitiveness of some of the Asian sectors where they're all competing for the same markets abroad. So that's just, in other words, in the non-US dollar markets. So that's just something to keep in mind, again, the exchange rate side of this.
Carlos, are you seeing signs now of this long-awaited recovery in personal spending in Japan and this virtuous cycle that the Bank of Japan wants to see?
We are seeing green shoots. I would just say the Q2 GDP numbers exaggerate that recovery. So we saw private consumption and private investment bouncing back into positive territory. In the case of private consumption, it ends a 5-quarter rout of contraction. So definitely very positive for the domestic economy. And it coincides as well with real wage growth. So, wages increased by the most in 20 years in March, but they haven't been able to keep up with inflation throughout the whole of this year. They only exceeded inflation in June. So we saw the first month of positive wage growth in June, and then a week after that, we see very strong recovery in private consumption in Japan. So of course, the market is pricing in very rosy outcomes in the Japanese economy. I think that the figures were also influenced by base effects following a contraction the same period last year. So I would discount that a little bit, but it is true that we have positive private consumption once again, and we do expect that this will be the beginning of a multi-quarter trend. However, I don't think the Japanese economy will continue to expand at a 3.1%, seasonally adjusted quarter-on-quarter growth rate. Things are going to cool down to around 0.6. So that's my forecast for the calendar year. And then if this recovery in private consumption takes hold, then you are looking at around 0.8% next year, which is above Japan's 20-year average growth rate of 0.6%. So it is positive, but just take the numbers with a pinch of salt. And then to what Enzio's point, absolutely, you have decoupling of central banks. Japan sticks out as the only bank that's tightening at the moment. And so we do see a gradual appreciation, which means that you are going to see some rotation away from those exporters towards more domestically oriented sectors or sectors that benefit from policy tightening by the Bank of Japan. So definitely there's also been a change in the investment paradigm for Japan from earlier in the year, where it was all in and unhedged, to a more calibrated, more measured approach.
And is the Bank of Japan back on track to raise rates? It raised rates at the last meeting. Governor Kazuo Ueda said they was going to raise rates more. Then the market turmoil came, and the deputy governor of the BOJ said we're not going to raise rates while the market's unstable. And sort of traders in the market took that as meaning no more rate hikes this year. So where is the Bank of Japan in terms of rate hikes now later this year?
The Bank of Japan doesn't care about the market turmoil, and the Bank of Japan doesn't care about the election in Japan, insofar as they don't impact the data. So I think that's what the deputy governor meant. If there's a lot of chaos in the market and that's impacting consumer sentiment and households are not consuming, and then you see signs that this positive wage inflation spiral is not taking hold, then they will not hike interest rates. If, on the contrary, you see some market turmoil, but it doesn't affect this ongoing structural narrative, then they are on track to do another 10 basis point in October. So it will really depend on, how the market reacts or how Japanese households react to the developments in the coming months. But my guess would be that the change in leadership will not significantly derail the October hike expectation. There was speculation that perhaps Ueda was under pressure from Kishida to do something about the inflation and the pace of JPY depreciation. And so with Kishida now out of the picture, they have less pressure. But remember that Ueda himself is the architect behind this return to policy normalization. So I don't think that the political pressure argument has a lot of bearing over the Bank of Japan decisions. So my guess would be that this leadership change will be a non-event, and then the Bank of Japan should be on track to do another 10 basis points in October. If we see a lot of volatility around the election, which is not my baseline, then this will be postponed to December.
Final thoughts from you, Enzio, on Japan?
I think that the yen is going to gradually strengthen a little bit from that base of, what was it, 150, 152 kind of thing. Started about 145, I believe, 146. So that will ease some of the domestic imported inflation, of course. That should make the consumer happier. But again, having covered Japan for many years, as we all know, in Japan, it takes time. Don't expect any fireworks. Once China does get going again, it will roar. And that will put Japan, I'm afraid, into the shade yet again as the steady eddy in the region. But I think the change in economic time in Japan is going to be there. And I think that's going to strengthen the yen just a little bit.
Thank you for your thoughts. You heard there capital preservation specialist at Financial Shield, Enzio von Pfeil, and Carlos Casanova, who is senior Asia economist at Union Bancaire Privé in Hong Kong.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
I'm joined now by Tokyo-based journalist and author William Pesek. Morning, William.
Good morning, Peter.
I want to ask you about 7-Eleven. The owner of convenience store giant 7-Eleven has received a buyout offer from Canadian rival Alimentation Couche-Tard, AST. They run the Circle K chain. What are the likelihoods of this going through? I would have thought there's some pretty big antitrust issues here in several places in the world, including Japan, but also the US as well.
You're right. Of course. I mean, the caveats abound where this is concerned. In many ways, you have concerns about Japanese regulators stepping up and saying no. I mean, as even you mentioned in your newsletter this morning, Japanese authorities tend to view these convenience store chains as critical infrastructure at moments of natural disasters like earthquakes. And, also there's great concern about, in some ways, about a Canadian company with a lot of debt. And one that has a smaller network of convenience stores than Seven & I does. And so questions about, will U.S. regulators also step in and say no? However, it is a fascinating crossing of basically crossing of the road moment for Japan, because you have had this effort in recent years to improve corporate governance, to increase the attractiveness of Japanese companies. And this, of course, is the largest takeover attempt ever by a foreign buyer. So it is this kind of moment where we're going to test the true tolerance of Japan's, willingness to let cross-border M&A enter the economy, but also alter the playing fields, if you will.
And I'm wondering what the government's view is going to be on that, because I'm not sure when it was talking about corporate governance, it quite meant this, did it? I think it was more interested in Japanese companies maybe divesting themselves of sort of underperforming assets, paying back more to shareholders. I'm not sure they envisage this type of thing happening.
That's a good point. I mean, I think Japanese regulators, in many ways, they've wanted to, as people say, have their cake and eat it too. However, now that we see, barbarians at the gate from overseas, as you will, rapping on the door saying we want we want to be part of the magic, Japan is thinking, wait a second. I've actually been kind of amazed that something like this hasn't happened sooner, because you've had the Japanese yen essentially down for 30% over the last 10 years at a moment when Japan is raising its corporate governance game. And, credit where it's due. I've been down on Abenomics on a variety of levels for over a decade now, but this is one of the areas where Japan really has made some important reforms and important changes. And this is validation of that. I am surprised it hasn't happened sooner, but here we are. And I think in many ways, this puts Japan in the global headlines, at least for the moment, for many of the right reasons. I mean, suddenly the yen's decline is triggering the M&A trend that you would argue that Japan needs to shake up the economy. The question is, what does Japan do about it? So we're seeing this true kind of activist investor renaissance in Japan. Will Japan be tolerant of that coming in from the outside? And that is a very open question right now.
It's also an interesting tie-up itself, isn't it? Because Couche-Tard is rather overloaded with debts. 7-Eleven, I think it's fair to say, is not doing that great at the moment, is it? It's sort of suffering from the same problem as Starbucks in that it's just got too many stores.
It is true, and in some ways, it's going to take on more risk going forward. You mentioned the debt issue. I mean, that certainly is something that could weigh on regulators, their decision here in Japan. It could in some ways affect how Japanese investors view this tie-up, and also in many ways there's the scale question. Basically you have a Canadian concern trying to take over a Japanese one which is larger than itself, and so is it biting off more than it can chew? So that is an open question, and I think that's why I said a moment ago that caveats abound. I mean, in 2022, you had KKR taking over Hitachi Transport Systems, and that was considered a very big sort of epochal moment for Japan's corporate governance reforms. This raises that to a whole nother level of magnitude and risk. So it is going to be fascinating.
And in the US as well, I mean, this would be a huge operation if they combined, wouldn't this? Because 7-Eleven's got more than 12,500 stores across the US. Couche-Tard has more than 7,000. They would be 10 times bigger than the next player in the market if they joined forces. I mean, it's hard to imagine the US government's being happy with that.
It's true. I mean, certainly from the standpoint of U.S. regulators, there's a lot of questions about the feasibility of this takeover. And it will be an interesting conversation, if you will, when Japanese and the U.S. regulators get on the phone, of course, behind the scenes, off the record, and have a discussion about this. I mean, one of the things that I find most interesting here is that Japan's convenience store network is one of the really interesting and true success stories of Japan. It's a validation of Japan's superb convenience store model, if you will. And I recently spent 6 weeks in the U.S., in New York City with my aging parents helping out. And I would walk into 7-Eleven there and I would look around and say, I'm not buying anything here. The food looks terrible. There's not a lot of selection. I come into one in Japan, and the convenience stores here are genuinely fascinating. Anything you want to find at 4 a.m., pretty much, you're going to find it. If you need olive oil, you're going to find it. If you need clothes for work the next day because you've had a rough night, you're going to find it. Any kind of food item you want to eat, you're going to find it. So I'm interested in how this in some ways reforms the convenience store chains network in the U.S. But I do think on a variety of levels, this is one of those forks in the road that it'll be fascinating to see where we are with the story 6 months from now. I've certainly got my popcorn out.
I have to say, I've never been a big fan of 7-Eleven, or certainly not the Hong Kong version of 7-Eleven anyway, which doesn't sort of have a lot of things that I particularly want to buy. But what I'm always amused about is at my local MTR station, when I arrive, there's a 7-Eleven at the bottom of the escalator. You go up to the top of the escalator and there's another 7-Eleven sitting there as well, just sort of like 50 yards away. It's an odd model.
Yeah, I mean, it's kind of Starbucks on steroids, isn't it, in many ways. But, Japan, it isn't only 7-Eleven here. You have Lawson, you have Family Mart, you have AM/PM Mart, you have Sun Us. You've got a whole variety of different competing convenience stores. And I guess in Japan, you can argue that's one of the reasons why you've seen so much competition and you've seen the convenience store model evolve the way you have. In the U.S., I think when it comes to convenience stores, you have a lot less competition. So is that about to change? It'll be interesting to see.
Now, let's turn our attention to Fumio Kishida. Since we last spoke, he said he's going to step down at the end of September. Why is he doing that?
Well, I think ever since Joe Biden stepped aside in late July, there's been a lot of talk in Japan about maybe we need that here, too. I mean, Prime Minister Kishida has been around for nearly 3 years now. His approval ratings are in the low 20s at best. His party's approval ratings aren't much better. And so I think in many ways, the LDP, the ruling Liberal Democratic Party here, was looking around and felt that ahead of next year's general election, they need a fresher face. They need a more popular face. And I think that Kishida, it's still unclear whether he made the decision wholly of his own or whether he was pushed by party elders. But he made the kind of selfless decision to step aside and let the LDP contest next year's elections with a fresher face. And I think it was the right decision, given the fact that with approval ratings in the 20s, there's not a lot of scope for you to reinvigorate the economic reform process over the next 12 months.
So what can the new leader do that's going to be much different from what not just Fumio Kishida's done, but what his predecessors have done as well? Is there really going to be any big change in the way the country is run?
I'd love to say yes, but not so much, because a lot of the to-be next leaders that are being spoken about, LDP heavyweights, former foreign ministers, current cabinet members, there's not a lot of daylight between what Kishida has offered and what these different candidates stepping forward are offering. And the other issue, too, is because the LDP is facing a general election that has to be held by October of 2025, the odds are very high that this next leader will be a short-termer, that basically they'll serve for 12 months, and that a year from now, the LDP will go with a different character. So in many ways, is this going to be a caretaker prime minister who doesn't have their own legacy to do much? So are we really taking a deep breath and saying, well, Japan's politics are going to be on hold again for the next 12 months? It's an open question.
And is he being also blamed for the state of the economy? Although the last piece of data, GDP data, was actually better than expected, but overall, it's still been a pretty sluggish economy, hasn't it?
It is. I mean, Japan's certainly experiencing a bit of an export boom at the moment. Japan's also experiencing a genuine tourism boom. I mean, I was in Kyoto last month, and oh my God, I mean, walking from point A to point B became impossible. So Japan is certainly benefiting from the weak yen on a variety of levels. The problem is that the weak yen is not translating into higher wages. You know, we're seeing blips here and there, but the trend lines are not terribly good when it comes to the idea that solid economic growth and tight labor markets are translating into higher wages. And when Japanese look at the Nikkei at record highs, they're looking around, looking at their paychecks and saying, what gives? And so I think that disconnect is one of the reasons why Kishida had a very hard time getting his approval ratings out of the 20s.
And does this change anything for the Bank of Japan and its plans to continue to raise interest rates?
Well, I think it does to some extent. I mean, I think, you know, the whole idea that the Bank of Japan is a purely independent entity, it's always been a bit out there. I mean, no central bank would keep rates at zero for 25 years if it were truly independent. That said, the BOJ raised rates last month, and I didn't like very much the reaction, right? Markets around the world said to the BOJ, whoa, what are you doing? Take your time. And so I think the idea that the BOJ might raise rates anytime soon when there's an election cycle taking place in Japan is a bit of a reach, because I think the last thing the BOJ wants to do is to be blamed for the Nikkei crashing, but also to be blamed or to become a central election issue in the next basically 4 weeks or so as the LDP finds a new prime minister.
And they've sort of retracted a little bit from their rate hiking stance, hasn't they? As a result of the market volatility, they're sort of suggesting they didn't want to raise rates while the market is volatile.
Exactly. I mean, basically, Governor Ueda came out of the recent rate hike talking very hawkishly, and it surprised many people. And the yen absolutely skyrocketed. However, I think that the BOJ looked at the reaction and they said, we don't necessarily like that. And I think that Japan's also worried about having a battle with the so-called bond vigilantes. If you see bond traders raising long-term Japanese interest rates more than the BOJ wants and more than the government's comfortable with, given that Japan has the largest debt burden among developed nations, that's an issue. So I do think the BOJ probably is going to throttle back on rate hikes for a bit to see where things go. The other problem is China, right? I mean, China is not exactly booming. China is Japan's most important trading partner. And if you see China losing altitude, is that the best environment for Japan to be raising interest rates? I'm not really sure.
William, always a pleasure to talk with you. Thank you very much indeed.
My pleasure. Thanks, Peter.
That's Tokyo-based journalist and author William Pesek.
Money Talk.
And thank you very much for listening this morning. You can, just a reminder that once again to take a look at my website, peterlewismoneytalk.substack.com, where you'll find my daily newsletter with a lot more business and finance news to go with the show. I'll be back tomorrow, and my guest will be Andrew Ferris, the CEO of Econosis Advisory, and Nick Marrow, Principal Economist for Asia at the Economist Intelligence Unit. And with a view from Taiwan is Ross Feingold, Director of Research at Sires Consulting in Taiwan. Please catch me tomorrow.
Money Talk.